Welcome back to Westwood's multi-asset monthly videos. I'm Ben Chittenden. I'm one of the portfolio managers and research analysts on the team. Today, I'm going to walk you through January's performance and some of our outlook thoughts for February of 2025. Start with the performance review. Since January and year to date are the same, I'm only going to speak to January's performance. But as the year progresses, we'll have the opportunity to compare and contrast trends between the most recent month and year to date performance. For equities, the month of January was very strong. Large caps generally did well, with the S&P 500 up 2.8%. If we look at the last 10 years, the S&P has averaged 80 basis points for January, so we're off to a very good start. What's even more important is that this is being driven by a broadening out of stock participation. There are a couple ways to think about this. First, value stocks significantly outperformed growth stocks in the month. You can see that in the Russell Growth and Russell Value columns on this table, where the performance difference was 2.7% for the month. Second, the S&P 500 equal weighted index outperformed the S&P 500 cap weighted index, which is the regular S&P you hear quoted all the time. The difference was 70 basis points. The final way to think about this is that mid-cap stocks were up 3.8% in the month, while the S&P was only up 2.8. This is all positive for the health of the equity bull market that started in November of 2022. We want to see this broadening out of participation, and that's how our portfolios are positioned. Moving on to rates. Here we see rates were largely flat over the course of the month, but that doesn't tell the whole story. If we take the 10-year yield as an example, it ranged from 4.4% to 4.8% over the course of the month. The driver of this was inflation expectations peaking early in the month, and as those concerns came down, so did rates. At the end of the month, we continued to get strong economic data, and so growth expectations moved higher. The net result was that the 10-year yield was flat, but clearly there was a lot of volatility in the month. In credit, we saw a bit of a divergence between investment-grade credit and high-yield credit. Investment-grade credit was largely flat. The reason for this is that spreads are already at multi-decade tights, and so it's hard to move too much lower even with the growth outlook improving. High yield was different. In the table, you'll see that the spreads declined from 287 basis points to 261 basis points in January. Now, that's a pretty big move in isolation. But with that said, the move was just recovering from the widening that we saw at the end of December. At 261 basis points, it's right in line with where early December was. So what drove the spreads for high yield? Again, as inflation expectations moved higher, so did spreads, as higher inflation could mean higher rates, which is a much bigger negative for high yield. When inflation concerns peaked in early January, so did high yield spreads, and the better growth kicker at the end of the month drove the spreads back down. Touching on commodities for a minute, it's not on this table, but the Bloomberg broad commodities basket was up 3.6% in the month. All of this is just to say that across most asset classes, January was a very good month. The next two slides provide a deeper dive into equity sectors and credit sectors. We'll leave that for you all to review if interested. Next is our capital markets outlook. We go through a consistent exercise every month to get our thoughts down for both the near-term outlook as well as our thoughts for the next 12 months. If you'd like to be added to the distribution list to get this sooner, please reach out to us and we'd be happy to add you. Now, there's obviously a lot of text on this slide, so for this video, I'm just going to give you the highlights, but it's worth spending some time reading through our thoughts if interested. First, we're really not that far off from the market on our expectations for growth and inflation. The consumer, which is the backbone of the economy, has remained incredibly resilient, and we don't think that is going to change. Where we are slightly different is that we do expect more rate cuts. So far, we're just projecting one more rate cut than the market, but we are leaning in this direction. What this should mean is that this should accelerate the broadening out of equity participation. We should see earnings growth converge with the largest mega cap stocks and the rest of the market, and this should drive better performance across a more diverse set of companies. While valuations are stretched, if we see the earnings growth materialize, this could help prevent us from having some kind of pullback. On credit, we're being selective as there are still good opportunities out there, but with spreads already so tight, we do want to be picky. On rates, we're more neutral interest rate risk. And here's why. While we do expect more rate cuts, and that should impact short-term rates, we also think the growth picture could improve and thus offset any changes in longer-term rates. Those are our quick thoughts for February. One thing we also include in our capital markets outlook is a chart of the month. This month, we actually have two. The first one just shows the average return for the S&P 500, and it's been 16% over the last 15 years. That does make it hard to not want to be fully invested in the stock market. With that said, we do believe that the insurance policy provided by holding fixed income still does apply, and that's how we're managing these portfolios. The second chart that we included in this month's capital market outlook is a version of Moore's Law. And Moore's Law states that the number of transistors on a microchip doubles every 2 years with a minimal increase in cost. Now, you hear something like that, and people talk about it as if it's a natural law. It just occurs. Like they went to sleep one night and all of a sudden they woke up and there were more transistors on a microchip. We view this more as human ingenuity. And that's what we view this chart as showing. It's 128 years of continual improvement in number of calculations that computers can do. And in order to get that, you have to have the engineers who are coming up with new techniques. You have to have the material scientists who are coming up with the new material to put transistors on. To us, it really just shows the exponential increase in what humans can do. It's a breathtaking advance, and we absolutely think it's worth thinking through. And that's the update for today. Look for a new video next month. And as always, if you have any comments, questions, suggestions, or if you want to talk about anything that's in this video, please reach out to us. We are happy to respond as soon as we can. With that, have a great rest of your day, and we'll see you all next month.